Hey, what's up, guys? Welcome back to the channel and welcome back to a revitalized and rejuvenated Vistro Ace. I have obviously been absent from YouTube for the past 1.5 months, and it is for good reason because I've been busy with something that has basically been completely out of my control, and I've also been traveling, which has enabled me to not really upload the high quality videos that I really wanted to. And well, with nothing short of a coincidence, that same time that I've been off YouTube has seen one of the worst declines in the stock market that we have simply seen over the past 18 months in this new bull market. Whether I should start uploading immediately to YouTube again to bring back the green that we've been so accustomed to so far in 2023 is something we're going to find out over the next 4 months as I start uploading much more consistently. But the fact of the matter is, after looking at all the data and the reasons for why markets have declined, most of this has to do with cyclicality. Yes, folks, that's right. I'm sure most of you don't even want to hear me say the word cyclicality, as I've mentioned that so many times in the past, but believe it or not, September and August have always been some of the worst months for investors in the S&P 500. And my technology, electric vehicle, and ESG focused stocks in the small cap sector have fared no better than the benchmark index. And as for why exactly does this happen, well, it has everything to do with something called earnings revisions. You see, September marks the end of the third quarter of the year, and it's typically around that time that analysts get an insight of what the next fiscal year is going to look like in the term of profit, earnings, and revenue growth for some of their favorite companies. And typically during the summer doldrum, when investors are out on vacation and school is off, investors tend to get this looser mindset of what's going to be projected for most companies' bottom line. That is exactly what results in July and June being some of the best months for stocks, with biggest rallies seen during that time of year, followed by a very strong first quarter. But guess what? Once those earnings revisions get priced in, markets actually tend to perform their best in the last 2 quarters of the year, with a typical bottom around the end of September for the last 10 pre-election years from 1983 to 2019. This is a trend of the average S&P 500 price action, and as you can see, so far this year, we have seen a very, very close resemblance in the performance of the line in blue and the line in gray, with the first 2 quarters being extremely strong, and then we're seeing a correction in the middle of the year, which obviously should be more than expected, especially around the time that Apple is launching the iPhone, which, as we all know, happens to be the best-selling product on planet Earth. Buy the news, sell the hype. That is simply what we're experiencing right now, and this minor pullback is certainly no reason to be pessimistic about the future of your companies or the fundamentals of the market itself. And why exactly do I say fundamentals? Well, because folks, just a few weeks ago, we got notice from the Fed about their intention to potentially raise rates once more in 2023. Even though in last week's FOMC meeting, they didn't do so at all. Let me say this once more for the people in the back. The government is essentially telling us that we expect to raise the benchmark Fed funds interest rate, which is going to influence mortgage rates, car loans, and everything that U.S. consumers use once more by the end of this year. But they're not going to do that now in September, or they didn't even do that back in July. This means the Fed is playing the once more and time and tested strategy of spooking market participants instead of doing anything material for the economy. Just like they said inflation was transitory or that rates won't rise until 2024, just 2 years ago, there's a really high likelihood that they're not going to follow through with this idea of higher for longer when it comes to the benchmark interest rate. The reason people have been freaking out is because in the dot plot that was released for 2024, the average interest rate estimate is now at 5.1% for the end of next year, instead of 4.6%, which many people assumed so far in 2023. Although this is a pretty small increment and generally still falls in line with cutting rates going into 2026, it spooked markets into creating this little frenzy of sell-offs for the unprofitable small cap growth stock that somebody like myself obviously has a big focus on. But as we've seen throughout 2021 and 2022, these estimates don't last because the government doesn't control the consumer directly. Instead, they influence what the consumer can do with the credit markets as well as oil and food prices. Although the 10-year yield has climbed 30 basis points in September so far, which is a pretty significant surge, it isn't the only reason markets have been spooked. The real reason for markets going down is the earnings forecast being cut as a result of this tighter monetary policy from the Federal Reserve. And just as fast as these earnings revisions are cut, they are also raised in the volatility and insanity of Wall Street today. Essentially what happened last week is that Wall Street cut its third quarter earnings estimate for the S&P 500 to $55.74 a share, down roughly 0.6% from the prior week. This doesn't seem like a big difference, but essentially this revision erased all the upside revisions we saw over the past 7 weeks going back into July. This means that although market participants expect earnings to still grow, it is not growing as fast as they expect, which has resulted in a 6% decline in the S&P 500, which definitely makes a lot of sense. It makes so much sense that, as a matter of fact, the iShares Russell 2000 ETF just had one of its worst performances since March of this year, with it being down more than 12% from its $200 high back in July, even though this ETF tracks the companies that are actually growing their revenues faster than the S&P 500 itself at a time when growth really is starting to stagnate for a lot of the non-tech companies in that index. If you didn't understand my sarcasm so far, there is nothing less sarcastic than this chart right here, which essentially shows us the US job openings overlaid with the interest rate from the Fed. And as you can see, the US job market is already declining, and this earnings revision going down really just falls in line with what the blue line is doing, which is exactly what we want to happen from an inflationary perspective, which essentially means the Fed's job is close to being done, then close to getting started, which happens to be exactly why this so-called pullback in the market right now in September is the perfect opportunity to add to your best investments. And although adding to your retirement accounts through ETFs that track the index and broader foreign markets is the best strategy to apply, I personally am also investing in some of my riskier small cap growth stocks that I have high conviction in the energy, innovation, software, and hardware spaces as follows. As usual, folks, there is nothing guaranteed in the market, so make sure to do your own research, whether investing in individual stocks or broader market ETFs. There is always risk when it comes to stocks. But as usual, folks, I hope you enjoyed this video and found some value from it. Thanks a ton for watching, and I'll catch you guys in the next one. Take care.